China's economy in for a bit of rough sailing, but on track to reach targets. What will it take to steer toward growth?
I can tell truth better hiding behind my character.
And in tonight's Writing China, author Yang Galing talks about her real-life experiences that fueled her prodigious work.
Hello and welcome to World Insight with me, Tian Wei. The program is coming to you Monday to Friday on CGTN. China's economy is facing some external headwinds as trade tensions with the United States drag on, but officials are confident about the economic outlook. Several monetary and fiscal measures have been taken to grow the Chinese economy. Chinese Finance Minister Liu Kun also said recently the government will provide support in a variety of ways. Before we start our discussion, take a look at this.
Several Chinese economy indices have had fluctuations, but experts say the economy is still manageable. 4 key macroeconomic indicators are all stable during the first 8 months of the year: economic development, employment, the price of goods, and the balance of international payments. Last Sunday, the reserve requirement ratio was cut again by 1 percentage point to 14.5% for large commercial banks and 12.5% for smaller financial institutions. This move is estimated to inject around 750 billion yuan into the banking system by releasing a total of 1.15 trillion yuan in liquidity, raising the capital available to small and medium-sized firms, which will in turn help stabilize the economy and ensure a stable employment rate. Chinese Finance Minister Liu Kun says besides the RRR cuts, the government has a card up its sleeves.
The proactive fiscal policies that we implemented in recent years offer flexible and efficient support for the economy. It's not just a massive monetary easing. As next steps, we will take measures in 4 areas: more tax cuts, improve links, and stimulate consumption. And lastly, the government will tighten its budget so we can spend more on people's livelihood.
The optimism of Chinese policymakers and experts is reflected at the international level. At a recent WTO meeting in Geneva, some experts are upbeat about the Chinese economy.
Such a big economy, and to make that move gradually is surely the right thing. So I think as China continues to grow and shift towards a consumption-driven economy and away from investment and export-led growth, that will be a win-win for everybody.
Economists expect more policies tailored to ease tax burdens, to raise employment, and to expand domestic demand to be on the way.
For more on the Chinese economy, joining us in Beijing, we have Liu Baocheng, the Dean of the Center for International Business Ethics from the University of International Business and Economics. In Hong Kong, we are joined by Hong Hao, the Managing Director and Head of Research at Vocom International. And in Shanghai, we have Huang Zhengyu, who is a former White House Fellow. Gentlemen, welcome to our program. I want to start with you, Mr. Hong, about the latest growth rate prediction coming from the IMF regarding China and the United States. IMF have lowered the growth rate of both countries' economies heading on to the next year. What does it mean for these 2 largest economies of the world and the rest of the world?
Yeah, well, I think, once you lower U.S. and Chinese growth rate, basically the growth rate forecast for the entire world in 2019 is lower than before. And I think today's downgrade is a rather substantial downgrade. But I think, because the IMF have a sort of a spotty track record, so even though the forecast has been revised down, one sort of should not take it too seriously, because historically the track record hasn't been very good.
Of course, the IMF prediction has always been a warning rather than a real, supposed to be a result of the economy. On the other hand, Mr. Huang, many are concerned, though, that China and the United States are not just in a quote-unquote war on trade issues, but rather a fundamental strategic conflict or competition. That seems to be reflected, at least from the U.S. side, by the recent speech, political speech might be, given by the Vice President recently regarding China. So what do you say if there is the possibility of that competition between the two of the world's largest economies? Once again, what does that mean for the rest of the world and the rest of the world's economy?
You're very correct, Tianwei. And I think there's 3 time frames through which we should look at this. The first is short term. Short term, I think, especially in China, we're going to see some economic slowdown and impact. Medium term, we might see a readjustment and realignment of the supply chain in China, with some of that supply chain potentially moving out of China, percolating to Southeast Asia and elsewhere. And long term, I think long term, we might see 2 economic ecosystems being developed, each somewhat disentangled from each other and each somewhat independent of each other.
Very interesting thought over there. Professor Liu, as someone who's been doing research about the Chinese economy for quite some time, what would you say about the recent IMF thought regarding the 2 economies, and also whether the 2 economies, China and the U.S., are growing apart rather than more in the same line? What does it mean?
Well, I think the IMF is really sending a very subtle message behind all those, the downgrade data, is that the world are really looking and depending on the collaboration between China and the United States as the 2 biggest economies. So they are calling for responsibility by those 2 big economy leaders. And in the meantime, the report clearly indicates that right now, under the globalized stage, the entire global supply chain will be disrupted by the Trump administration's stubbornness to move against many of those trading partners, particularly with China. So therefore, the business community will also read this message in a pessimistic way, that they need to make substantial adjustment, given that we cannot really see an end of the escalation of the trade war.
But Mr. Huang, it seems that what you're suggesting earlier, responded by Professor Liu here in Beijing, more to do with, let's just say, one example of that is the United States trying to create a free trade agreement with Mexico and Canada, also working on, as Washington indicated, for example, with the EU, with Japan, and therefore having its own way of doing and portraying trade globally, rather than relying on the traditional system of WTO. But the question is, that means quite a period of time of uncertainty. So that is not a good news for the world economy either. And Mr. Huang, very briefly about that point.
Yes. So I think there's a fundamental difference between the U.S.'s trade discussions with other countries and between U.S. and China. With the other countries, it's really around trade concessions. But I think in China, there's both trade concessions and disentanglement at play. Now, disentanglement, as we know, especially from certain of President Trump's advisors, such as Peter Navarro, means disentangling the U.S. from Chinese supply chain, Chinese manufacturing, even Chinese capital. Now, what does President Trump want? I think he probably wants a bit of both, trade concessions and disentanglement. And ultimately, I think that's the force at play. And even if China concedes to some of the demands, not all of the demands of the United States, I think China may also work towards disentanglement, especially earlier on, as we know, we had an incident, a huge incident with ZTE, with the Chinese recognizing that maybe too close a connection to the American supply chain might be difficult for it as well. So that long term, I think, is the bigger story.
Mr. Hong, we don't know what the President of the United States wants because he's been shifting over the times. And what we know, and what we do want to know, is what does that mean? The shifting of policies, the concerns about what exactly is going on between China and the United States in the long term mean for the world economy and therefore for the two world's largest economies as well. Mr. Hong, with regard to the possibility of strategic competition indicated earlier by the U.S. leadership at least, what does it mean for the rest of the economy? Should they hibernate now to prepare for the winter?
The uncertainties in the system is increasing. I mean, obviously, as you pointed out, I think even Donald Trump himself doesn't know what he wants. So it's very confusing, and also for people working with him as well. I think, you know, the setup for sort of two great nations start to compete with each other rather than like before, these two nations, they complement each other. The relationship is actually changing. You know, the sort of a mutually complementary relationship, that period has passed. So I think going forward, you know, we're probably going to see sort of some conflicts intensify, more debates happening between two sides. But then hopefully, you know, with the greater good mutual interest inside, you know, we can work out some sort of a solution, even though in the new era it would be a more competitive relationship rather than a complementary relationship.
And therefore, the question should be asked as to what the economies, the two of them, particularly China's, for our program today, is doing. Mr. Hong, we understand the bank reserve ratio, for example, over the past few days has been decided by the Central Bank of China to be lowered, and that is already the fourth time of this year to do that. Meanwhile, you earlier heard from our background report about Chinese finance minister suggesting about several ways that the government is working to give momentum to the Chinese economy. Mr. Hong, the question is, will these policies really address some of the key issues and key concerns of China's economy at large?
Well, we've cut RRR multiple times this year, and also, you know, since the beginning of this year, we've been trying to lower tax burdens for businesses. I don't think there's a huge problem with the overall economic growth. We're still seeing 6.8% GDP growth plus 2% inflation. So nominal growth is actually quite reasonable, especially when you consider the headwind that we're facing from the trade war. Now, the problem is that really we have a structural problem here. The national firms are doing very well, but then smaller firms is probably finding it challenging to access bank credit, you know, in this new system. So that's the reason I think why, after 4 times triple cut, we are not seeing the smaller guys doing, or the situation for smaller guys improving. So probably more efforts needs to be addressed in that area.
Therefore, Professor Liu, we have to go to you about that too. The bank reserve ratio cut certainly is going to give liquidity to the market, 1.25 trillion, that in RMB at least, that is what we're talking about, though almost 1/3 of it is going to address earlier bank loans. Having said that though, Professor Liu, what would these liquidity mean for the Chinese market and the Chinese economy, particularly that balance about addressing the liquidity issue while at the same time looking at the growth rate and the quality of the growth?
So right now, it is a very clear message the growth rate is the primary target for the government to maintain, and that has to be supported by a higher level of liquidity and the velocity of the money. And in the meantime, while the government is cutting down on the tax burden on business community, they also wanted to support the better access of financial resources by those smaller companies, which are really the backbone of the Chinese economy and Chinese employment. So therefore, the government is facing a very tough challenge between deleveraging, which is the continued efforts over the past 2 years, and also to shore up the existing economy that's over there, and plus that the local governments are also really getting cash crunched with many of those gigantic ongoing projects, and the central government does not really want to see that they are stopped halfway.
So therefore, Professor Liu, if I could just press a little bit more, where is the growth engine as you see it?
Well, the growth engine is really continued supply side reform to address the structure. And the other, of course, is to support domestic consumption. And the third one is also to support companies to look for alternative marketplace so that our export momentum will not be severely damaged by this looming trade war between China and the United States.
I see.
So I think ultimately, actually, what the Chinese government is doing is to go to the upstream to entrench the capacity building for smaller firms. I think that's the right thing to do.
Well, all of these are taking place in China, Mr. Huang. We understand from Washington, particularly the Trump administration, has been even talking about claiming China as the currency manipulator. Many say that is really groundless accusation. But obviously, you have seen a Washington that is overruled by politics rather than logic at all. Mr. Huang, as a result of this, what does it mean for China and the United States to be able to still work together in any way at all? After all, China is still a strong holder of the U.S. foreign, is still buying U.S. debt together with other developing and developed economies such as Japan as well. So will this fundamentally, in a way, hurt that very important relationship too?
This is a great question. Now, obviously, there are still points of collaborations, especially around North Korea, and that's an ongoing collaboration. But I think today there's actually an amazing opportunity for China to deepen its engagement with the rest of the world, even with the tension with the United States ongoing. And what by that is, China has established tremendous relationships in the developing world, in particularly in Latin America and Africa. It has a chance to deepen those relationships. But more importantly, President Trump has put doubt into the minds of traditional allies, European Union, Mexico, Canada, and otherwise. And it's amazing that countries like Canada are having second thought on whether they can trust the United States going forward. And so China actually has a chance to potentially engage these traditional allies and form closer engagements with them during this process. And I think if that's done right, we'll see actually a tighter integration in the world sphere.
Well, Mr. Huang obviously is doing some strategic geopolitical thinking, but Mr. Hong, I'm also very interested, as I mentioned earlier, about this relationship that China and other countries buying the debt coming from the United States to, in a way, support the consumptions inside the United States, but that has also been providing a stabilizing factor in the relations between the two economies for a long time. But what about the future, Mr. Hong?
Yeah, I think the future is changing right before our eyes. If you see the Chinese economic structure is changing as well, Chinese is spending more. Nowadays, 70% of the GDP growth is actually from consumption. And also, if you look at the current account surplus that China has been enjoying for many, many years, current account surplus as a percentage of GDP is actually declining very fast. So the Chinese people is entering into a stage of dis-saving, so they're consuming more. Now imagine two of the biggest economies in the world, they are both consuming. So who is left to produce all that goods? So one has to think about that, in the new world structure.
Professor Liu, the latest report coming from the Chinese side suggests $22 billion less China's foreign exchange reserve. Of course, when you compare how big that reserve is, it is a small amount. But given what Mr. Hong just mentioned, how is China now gradually re-engineering its growth format, and how is it working with the current circumstances?
I think Chinese government is getting more confident about the foreign exchange reserve, where they realize that a huge surplus won't really do Chinese economy good, and so therefore to support domestic consumption is the right type of approach, and that can really help China to get engaged in the dramatic transformation. It's really the demand that really pushes for innovation and also for self-reliance. So therefore, to strategically reduce the total amount of foreign exchange reserve, and hence that pushes for a better liberalization of the Chinese currency, can really serve China's strategic good.
Mr. Hong, you agree with that?
I think so, but keep in mind that in 2015, August 2015, China actually took on currency reform, even though, you know, at that point in time we pay a hefty price, you know, because the market was very volatile back then. But ever since then, the Chinese currency, the currency exchange rate is actually pegged to a basket of currencies, and also we actually told the market participants what those currencies are, so one can easily figure out, you know, what would be the asking price for the next day's open, so and all that. So I think, you know, the relationship between the Chinese yuan and the US dollar is probably less tight than before. So as a result, you know, in the recent Fed hiking rate cycle, the Chinese central bank has the luxury not to follow the interest rate policy of the Federal Reserve.
That is certainly very interesting point. Mr. Huang, leading up to the midterm election, I think it seems that in the United States these days there's only one phrase that really works, that is midterm election. Everything is related to that. We see so much political fights, and we see policies shifting as a result of that one goal, and that is the only end goal for now. How are we going to see the policies of the Trump administration post the midterm election if there are some changes in the Senate and in the House of Representatives, if the political dogfight drag on further and more as it is already beginning this time? What would that mean for the U.S. economy and some of the most important economic policy-making process inside Washington? Mr. Huang, your thought?
Yep. Actually, I think there are two factors. The first is obviously the midterm elections, and more importantly around the idea of Democrats gaining control of Congress, either the House of Representatives or House of Representatives plus the Senate. And if the Democrats regain control of Congress, it is very likely that they will initiate potential impeachment, or at least to go very hard in terms of scrutinizing everything and everyone around Donald Trump. So that's number one. Number two is actually a potential economic slowdown. We know that on the surface, the U.S. economy is booming. Unemployment rate is the lowest since 1969. Rates of growth is over 4% in the last quarter. However, the United States has enjoyed almost uninterrupted economic growth since 10 years ago. And everyone that I know is talking about, when will the next downturn come? We know it's going to come. When is it, and what are the catalysts? We can already see that real estate prices, which have been going steadily through the last cycle, is now tempering down and actually decreasing in some of the key markets. So there's this foreboding that the slowdown will come. And when that will come, coupled with potentially the next election cycle, I think that's going to be a very interesting watch.
We'll see how things will go, but one of the most important hope, I guess, that could represent probably everyone watching our program today, that is, we hope the policymakers are making their decisions for the better lives of the people. For now, I want to thank all of you, gentlemen, for being with us. Liu Baocheng, Hong Hao, and Huang Zhengyu. Really appreciate it. Thank you so much, sir, for being with us.